And this is why I've always said we have to watch the unemployment rate, because you can see in this chart over here, the orange line is the unemployment rate. The blue line is the mortgage delinquency rate. Now, the Equifax data only goes back to 2012, but I've actually taken information from different sources, and we can see we've gone all the way back to 1995, which matches the previous source of where I got the mortgage delinquent data. You can see it's almost an identical line with a couple kind of delineations over here and obviously here. Now, I can tell you for a matter of fact that this one over here clearly came from the pandemic when people basically lost their jobs, but because of all the liquidity that came in, delinquency rates went down. So you can see very, very closely right here that the correlation is almost the same. So when I say we have to watch for unemployment rate, Canadians are underwater, mortgage payments are piling up, and rate relief may not be coming for homeowners. Mortgage defaults in Ontario just spiked 71% from last year, and the Bank of Canada might just pause rates on their next announcement on June 4th. That's a dangerous combo. So let's dive right into it and see what's happening with mortgages and what to do if you're falling behind. Hi, my name is Zen, and if you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. So this article came out with a lot of the new mortgage delinquency data. And the definition of mortgage delinquency in our case, as followed by Equifax, is basically any mortgage payment that is 90 days past due. So effectively, if you haven't made a mortgage payment for 3 months, then you are now delinquent. Now, Equifax has basically been tracking data since 2012, and they're saying that the 90-day mortgage delinquency rate has risen 71.5% in the first quarter of 2024. That is a really large increase from last year because you're going from basically 0.14% to 0.24%. But to put that into context for you, how many people are actually not making their mortgage payments in the last 3 months? So when you take this number from last year, call it 0.14%. Remember, it's 0.14%, not 14%. And you divide this by the 14%. That means every 700 mortgages or so, you have one delinquent mortgage. So that's what it was last year. Now this year, because it's risen to 0.24, so you divide that by 0.024, now that's 1 every 400 mortgages. So yes, it has gone up substantially, but it's not like there's gonna be a lot of power sales right away. Now, one thing I will note is in most situations where if you're a B lender or a C lender, there are provisions in the mortgages that say, hey, the minute you're delinquent, even 1 month, they can power sale the home. But it really depends on what the home is worth and how much debt there is on it before someone actually executes the power of sale. So there's no blanket way of saying, hey, we're gonna see a lot of power of sales because mortgage delinquencies are up. What I can tell you is obviously there's a correlation that as delinquency increases, power of sales should also be increasing. So you can see there are a lot of articles right now talking about whether homeowners or investors are in trouble as you have a lot of Canadian mortgage impairment. I have talked about this in the past before where Bank of Canada came out with their stability report. And this is a chart a lot of people are referencing. So Equifax was looking at a history since 2012 of whether you're delinquent. If we look here, you can see that this is marking what a percentage of an impaired loan at the Canadian banks are, so your big banks. So you can see this yellow line over here represents residential mortgages. So you can see here, we got as low as 0.28% of impaired loans on the mortgage residential side at big banks. But now where we are right now, it's 0.43. So they have gone up 70, 80%, which is similar to what the Equifax number is. So is this cause for concerns? Yes, to an extent it is, because we haven't hit that quote unquote recession yet, and more bad things are to come. Obviously, we're having a slowdown from the trade wars. If something is going to iron out, we don't know. And a lot of that uncertainty is going to cause a lot more kind of economic damage. And if we start seeing more unemployment rate, that's going to be a problem. And this is what I talked about in the last video. The thing we have to watch for right now is unemployment rate, because there's a really big correlation between unemployment rate and the delinquency rate. You can see in this chart over here, this is the mortgage delinquency rate using a different subset of data, not the Equifax one. So you can see we've gone all the way back to the 1990s. So in the 1990s, that was when we had a really big real estate crash and we got as high as 0.6. So when you take that number and you divide by 0.6%, you have 1 in every 166. So let's just say in the 90s when we had a really, really bad real estate crash, that was 1 in every 166 homes. So there's about a 3 times difference between where we are now versus to where we are in the 90s. And you can see even though it is rising quite sharply, we're still in a fairly low percentage right now. It is 100% going to continue going up and up, but where will it stop? We don't know. And this is why I've always said we have to watch the unemployment rate, because you can see in this chart over here, the orange line is the unemployment rate. The blue line is the mortgage delinquency rate. Now, the Equifax data only goes back to 2012, but I've actually taken information from different sources, and we can see we've gone all the way back to 1995, which matches the previous source of where I got the mortgage delinquent data. You can see it's almost an identical line with a couple kind of delineations over here and obviously here. Now, I can tell you for a matter of fact that this one over here clearly came from the pandemic when people basically lost their jobs, but because of all the liquidity that came in, delinquency rates went down. So you can see very, very closely right here that the correlation is almost the same. So when I say we have to watch for unemployment rate is that if unemployment rate goes up this way, you know delinquency is going to go up this way, which also means that power of sales will go up. Now, before anyone kind of freaks out, you have to understand a power of sale is when the bank takes possession of the property, not on title, takes possession and sells it on your behalf. And what the bank is trying to do in those situations is recoup any loans or any money that they lent out to you so that they're not going to have to write off their loan. So if the property is worth $2 million and there's a $1 million loan on it, any surplus between it, so that $1 million surplus or what we call equity, actually gets given back to the seller. In the case where the bank takes all of the equity, that's a foreclosure, which is very rare in Ontario. So just because power of sales go up doesn't mean that the average price is going to come down. Because a lot of times I have seen power of sale deals that are actually terrible because the amount of debt on it is really bad relative to what it was appraised at. However, on the flip side, I have seen some pretty good power of sale deals. But where I do think most of this is going to happen is a lot of the power of sales are going to happen in the B lending space and the private lending space because they are more concerned about getting their money back. Until unemployment rate gets so high where it becomes the bank's problem, then it's where we may get some intervention. But I don't think we're going to be there right now. But what I will watch for right now is if the unemployment rate gets to 8%. And I said it in the last video. If we get to 8%, I think we're going to have a lot of problem. I know Ontario's at about 12 right now, and it'll probably continue going higher because of the trade wars and kind of the automotive sector. But so much of this is unknown right now, so we have to play it by ear. But if you're looking for a leading indicator of where home prices are going to be, look at the unemployment rate. That is the biggest thing I am personally looking at right now for all my clients, depending on what they're trying to do as well. Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, but decades of experience to work for you. So what do you do if your Toronto condo or Toronto home is worth less than your mortgage? That's what you call underwater. But really, the bank doesn't know whether you're underwater or not. The bank only cares if you continue making your mortgage payment. So if you are delinquent, the bank's not going to immediately call a power of sale on you right away. You can still work something out with them. Or if the value of your property is less than your mortgage on that property, the banks don't immediately say you have to sell the property. You just have to carry it out. So if you are underwater, what you do have to watch out for is you have to cover that financial gap. So this is in real estate what we call a short sale. And this very rarely has ever happened in Canada. It happened a lot in 2008 in the US, but we may start seeing a lot of that right now in a situation where if someone can no longer carry the property if they lose their job. And that's what we got to watch out for. So let's run through a scenario where you lose your job because of unemployment rate, and then you're going to start becoming delinquent and you have to sell the property and you're underwater. So what's going to happen? So let's say your property market value is $500,000. Your remaining mortgage on this is $550,000. And then when you subtract the two, you can see you're going to have a minus $50,000. So then you have to also add in the selling fee. So call it negative $25,000. And you have closing fees of $1,500, give or take. So when you add it all up, if you were to sell the property for less than it, you actually have to pay out of pocket $76,000 on closing, as opposed to gaining some money, which most people have been accustomed to. So if you do not have the $76,000, you can actually close on the property. So the bank won't discharge the mortgage, and then you're gonna be in bigger trouble with the contract you signed with the buyer. Before you even think about selling, don't let another chatbot price your biggest asset. Your property is not just another number. Hit the link in the description below and I'll send you a personalized assessment with real data and expert insights so you can sell with confidence on your terms. So this is all things that could potentially play out as things get worse and worse if unemployment continues to increase higher and higher and higher. Now, I wanted to highlight a couple of these questions here because I've been getting asked a lot of these questions as well. So what happens if your mortgage comes up for renewal? Well, they're not going to re-qualify you right now, but you can also shop it around with the new kind of mortgage rule changes. But what happens is you have to roll it into your next mortgage term based on whatever the rate is, and you just got to calculate if you can afford that. But generally, if you're losing your job, it'll be very hard. And the biggest thing that a lot of people are asking me right now is when is the market going to come back? Right? So especially for condos, I would say it's going to be at least 2 years roughly because we have so much inventory right now. your average months of inventory, so as a ratio of how many properties for sale versus how many have sold, is about 8. So for us to get back to where prices stop falling, you have to get to the months of inventory of at least 4, which means we have to double the amount of sales we have relative to the amount of active properties that are coming online right now. So new listings. So let's just say hypothetically new listings stay flat for the next year. We have to double the rate of our sales or go back to the 10-year norm, which we're not at right now. And I just don't think we're going to be there anytime soon with all this uncertainty. So if you're waiting for the market to come back, then you may have to wait at least 2 years and be prepared for that. And just also be prepared for rents to be continuing to drop lower in the Toronto condo space. For homes, it really just depends on where your home is because every single area is behaving differently depending on the price point and what your property is. For anyone who is hoping that there's going to be some kind of relief with all of this, as with a lot of things are changing, the latest data basically suggests that Bank of Canada on Wednesday isn't actually going to cut. There's a 20% chance that they're actually going to put a pause. But regardless of that, people are thinking that the rate cuts are going to be coming later on this year. And like I said, I'm expecting another 2 rate cuts by the end of the year, maybe call it July or September. But my money's still on that we may get a rate cut in June. But so many things can change. But do not use this as an indicator that the market is going to come back to life. What they are doing right now is just trying to put out fires in the economy right now. This rate cut isn't meant to save the housing market. It will have a side effect of helping those with a mortgage keep their carrying costs low if they have a variable mortgage. But if you have a fixed mortgage, it doesn't do anything for you. And if you have to renew into it, your rates are likely still higher depending on when you got your mortgage. So understand that a rate cut may help carry costs, but it won't help the sentiment, which is one of the biggest driving factors right now. And until a lot of this uncertainty from the trade war kind of goes away, I really do not think we're going to have our sales revert back to the 10-year average so that the months of inventory can come back down so that price can eventually go back up. We're very far along from that. And if you want a deeper dive on how we may lose 100,000 jobs, according to TD, make sure to check out the video that's on the screen. We're going to a deep dive of how those job losses may cause rate cuts, which may cause lower mortgage rates, but it still may not mean that the real estate market is going to be bouncing back right now because people are losing their incomes. I'll see you in that video. Until next time, your move, your future. See ya.